5,863,900 ounces of gold have already been delivered on COMEX this month. Every single month, we're seeing this kind of volume. That's never happened before. No one ever stood for delivery. AI will eviscerate 50% of entry-level jobs in less than 5 years, according to a recent study. Why has silver not performed? It's because there are 8 Western banks that have held the largest concentrated short position in the history of the COMEX market. You want to play this game? We'll beat you at it. We'll suppress the paper price too, and we will stand for delivery as well because now we're wealthy. And now we see what you're doing. In fact, we're smarter than you. We will use your suppression of the paper markets against you. And that's what's happening.
Okay, ladies and gentlemen. So today we have Andy Schectman, the CEO of Miles Franklin Precious Metals. And today we will look at the US economy, commodities, precious metals, of course, advice for younger investors, and many other very interesting topics. So Andy, thank you so much for being here.
It's finally great to make this happen, man. I'm sorry we've had such a difficult time connecting, but thanks for your patience and thanks for having me.
Very happy to have you on, Andy. So much happening right now, but I'd like to start with the macro picture. So what's your take on what's going on with the US economy and what would be some of the things that you are paying attention to right now?
I mean, that's a big question, of course. The macro picture, we have a debt that's spiraling out of control, north of 38 trillion, $1 trillion increase in about 71 days, which is unsustainable. We have a government that can't agree, again, with partisan politics. Here we are shut down for an extended period of time, creating greater problems all around the ecosystem from entitlements and food stamps all the way up to the military. We have a Fed announcement today, I believe, or tomorrow, where they are going to presumably lower rates. Again, their inflation target, as measured by the CPI that comes out of the BLS, tells us that inflation is at 3%. Now, John Williams of Shadow Stats would say, no, try 11%, add an 8 to that number, because if we just simply measured inflation by the way they used to, we're at about 11%. But even if we believe their BS 3% coming out of the BLS, Bureau of Labor Statistics, that's 50% away, 50% from their target of 2%, which they've missed for, I don't know, almost 60 straight months. They call it tepid inflation, yet it's 50% away from their target. They will come and lower rates again to pour more inflation, or more gasoline rather, on the inflation fire. And we have a labor market, which again is quoted by the BLS, which in many ways is not right. It's much worse than they tell us, and it's already kind of bad and getting worse. I don't mean to sound overly pessimistic, but the fiscal irresponsibility is beginning to catch up with us. And when you are creating, in essence, $1 trillion of debt in less than 2.5, 3 months, and 1 trillion seconds ago was 31,688 years ago. When you look at a market that has rallied to all-time highs based on the performance of 7 stocks, all-time record poor breadth, the worst ever. When you're looking at a system of record low savings and record high indebtedness, and a Federal Reserve that is trapped, and a government that can't even agree on basic things to keep the lights on and keep things running, I am not overly optimistic at this time as to the short-term direction of the economy. And I don't do that to be pessimistic and try and sell precious metals to the crowd based upon fear. That's not it at all. It's just that at some point, these things have to start to have meaning. And that largely is the irresponsibility of our fiscal policy that's just spiraling out of control. And I think it will come home to roost. At the same time, I guess I would like to add one other thing from a contrarian indicator. Since the beginning of the year, we've seen constant outflows by the institutional investors out of the equity market, constant outflows. We've seen guys like Warren Buffett sitting on 500 billion in cash. Jeff Bezos sells 7 billion in Amazon. Zuckerberg selling a bunch. Jamie Dimon selling a bunch. Um, we're seeing the inside money leave at a very fast clip out of the equity market at all-time highs. At the same time, we see the retail public, mom and pop investor, who is at an all-time high in terms of their allocations to the precious metals, excuse me, to the equity markets. All-time high, like 55%. At the same time, all-time high on margin debt, which is speculation and leverage. An all-time high on option debt or option plays. So you have a public that is all-time in speculating on options, all in the market itself, speculating on options and on leverage with margin debt, over $1 trillion, all-time high on all three, as the smart money is moving the other way. So I think it's you ask yourself what could possibly go wrong. Um, I'm not overly optimistic right now. I wish I were, but I'm not, and I think change has to happen. I think we're in the midst of watching change, maybe even a new monetary system happen right out from underneath us right now.
Yes, it's all transitory, Andy. If so, with everything that we talked about, with Fed trying to lower interest rates, with inflation being potentially higher than they want us to believe, that doesn't look good for the US dollar, right?
No, and that's part of the problem. You're right, it doesn't. But there are those that believe, myself included, actually, that this may be an attempt to debase the dollar, an attempt by the government in every way, even though they're talking one way, their actions are signaling something different, to debase the dollar. And it's called the debasement trade, the devaluation of the dollar. The reasonings would be easier to pay off the debt. And I believe their idea ultimately is to debase the dollar further than people think possible in order to bring back manufacturing. It's the only thing, the only hope we have at this point right now is to bring back manufacturing. You have right now, normally I'm in my studio and the monitor is much bigger where I can see a couple of the notes that I wrote down, but we're having problems with that. And I can see a golf ball 250 yards away. Computer screen 3 feet in front of me, that's a problem. 60% of this country has a reading ability not higher than a sixth grader. 60% of this country has no college education. Um, AI will eviscerate 50% of entry-level jobs in less than 5 years, according to a recent study. We don't make anything anymore. Um, and we have a massive divergence between the people who have money and the people who have none. Um, we're in trouble. Our children are in trouble. Our grandchildren are in big trouble if we don't bring back manufacturing. But Triffin's dilemma, which is a economic theory that says as the world reserve currency, you will always have a problem of a trade imbalance and a loss of manufacturing because what happens is that you can't give the world enough in the way of dollars as the reserve currency through trade alone. And their needs for everything from, loans to purchasing commodities like oil to just running day to day across the board, there's not enough dollars out there. So they have to sell their currency in the open market. We're continually creating currency and they are continually buying currency in order to our currency in order to do trade. That lowers the value of theirs and strengthens ours as the demand for more and more dollars to facilitate global trade accelerates. You end up with a strong dollar against weak currencies. Now, that doesn't mean the dollar is strong. It just means it's strong against a basket of crap currencies. But over time, the continuation of doing this makes manufacturing flow towards the countries where it can be produced for a fraction of the cost. And that's why we've had cheap goods forever through, Walmart, because manufacturing left this country and went to places like China and Vietnam, where it was a fraction of the cost to make that product. And so you will always run a trade imbalance. The former chief economic advisor for the White House administration, or the Biden administration at the White House, rather, a true knucklehead in every sense of the word, was Jared Bernstein. If you ever watched him try to explain on X how treasuries were created, it was one of the most humiliating things I've ever seen a politician do, or a person in a high-ranking position such as Jared Bernstein. It's you should watch it if you haven't. Anyways, he wrote a report called Dethrone King Dollar a few years back, advocating for exactly what I'm saying, that being the reserve currency because of Triffin's dilemma is past the point of benefiting us. For many years, we had low price goods at the store. We had low interest rates because the world would take their excess cash and put it into U.S. Treasuries, dropping interest rates, or dropping interest rates and raising bond values. So it was great for us. We had high asset prices, cheap goods, low interest rates. It was great. But now we're past the point of it being a benefit. We're too far down the road in terms of indebtedness, and we're running into a point where the world is changing and we don't produce anything. And if you're not working in California or New York in terms of tech and AI or financial assets, and maybe even Hollywood, which is even moving more towards AI, you're dead in a general sense of the word moving forward. And so I think what they want to do is grossly devalue the dollar. And they'll do that through letting commodities like gold and maybe even Bitcoin go much, much higher, to bring back manufacturing. It's the only way. You have Vice President Vance, who has recently said the same thing on White House letterhead. Triffin's dilemma says that the world reserve currency is no longer a good deal for us, more or less is what he said a few months ago. They understand this. And if we want any hope of our children and our grandchildren having a future, let alone national security, we can't rely on China for pharmaceuticals, from aspirin to penicillin. We can't rely on China for all of our military components and aircraft components and everything. We need to do this. And not only that, for 60% of America with less than, a sixth grade reading level and no college education, if we don't, we're dead. And I think this is an issue of national security. So saving in dollars, in my mind, is the worst possible thing you can do. You'll go broke. As Rick Rule, who you had on your show recently, a good friend of mine, says, you save in dollars, you're destined to go broke. You're not a contrarian right now. You're destined to be a victim. And I'll quote him in saying that. It's true. And we're at that point where, there is a way to grow ourselves out of this problem, but it could take a long time. Short of that, as my mentor used to say, the Federal Reserve is boxed in. They have two choices, but to hyperinflate or default. Inflate or die, he used to say. And that's true. There is no other way out when you have a literally $200 trillion debt obligation, 38 that we talk about, but Medicare and Medicaid and Social Security, government military pensions are all unfunded. So if we don't do this, if we don't find a way to do this now, and kind of like the movie The Shawshank Redemption, where Andy Dufresne had to crawl through 2 miles of shit to get to the other side. Well, there is hope on the other side, but you got to crawl through that too, one way or the other. And I think they understand that, and that is to bring back manufacturing. And I think they will do that with the implementation of the Genius Act, which we can talk about if you'd like, which creates synthetic demand for U.S. treasuries and other things. And Judy Shelton's idea of pegging gold to the back end of the Treasury market on July 4th, saying Trump told her he would do this July 4th next year, the 250th anniversary of the country, which would enable you, if done properly, to bring back manufacturing at zero upfront borrowing costs. So I do think, to your point, intuitively, yes, it is bad for the dollar, but there might be more to that than meets the eye, I guess is what I'm trying to say.
Very good points, Andy. And so from one side, yes, we do have things do look very inflationary. But on the other side, we have debt levels and stock market valuations that if that bubble bursts, that could bring deflation. So how are you seeing this relationship?
Well, I would argue in many respects we're seeing deflation. People don't notice it because the dollar is inflating, and so prices are getting more expensive in dollar terms. But take an ounce of gold and measure anything that you can in ounces of gold. Go back as far as you want from 1971 on. Go back and measure it in ounces of gold, and you'll find prices are actually going down. Let me show you this way. I'm going to ask, let's see, what was the average house price? Should we do 20 years ago? Let's try 20 years ago in 2005. I can write this down too. Okay. Average house price in 2005. It says the median price was 232. The average was 297. Let's take 297. Take the higher price. All right. And what is the average price in 2025? In 2025, we have 534,100. So your real estate has gone up in value, right? And that's good, right? But let's measure it in gold because in dollar terms, that same house has gone up $240,000, right? Almost 50% gain in 20 years. Not bad, right? So let's look at what was the average price of gold in 2005. What do we get? 449.99. Let's call it 445. 444.99. Let's call it 445. All right. So in 2005, 297,000 divided by 445 would have cost you 667 ounces of gold to buy that house 20 years ago. It's gone up 50% in dollar terms, but how about if we measure the price of gold today against the price of that house? Gold right now is up day $70, $4,031. So we take the average price of 534,100 divided by 4,031, and you get 132 ounces where it took you 667 ounces 20 years ago. Do you see what I'm saying? In terms of the price of anything measured in ounces of gold, you can now buy 5 houses almost, 4 to 5, and that's an asset. Everyone says, well, it doesn't pay any interest. Well, who cares? That's what it's done forever. You go back to 1900, and I can give you examples that show the same thing. Retains its purchasing power. A $20 gold piece in 1900 was 1 ounce of gold, basically, just under 0.9675. And $20, which was the face value, would have bought you a suit, a tie, shoes, overcoat, everything. And that's about what it would have cost you. The whole 9 yards, looking like a stud. Today, $20 won't even buy you shoelaces and a tie. Won't even buy you a tie, not even close. But yet that ounce of gold will still, that $4,000 will buy you one hell of a nice outfit. My point is that gold doesn't pay interest, but what it does is it measures the value or the lack of value of the currency. And the problem is, and there's the problem is people are focusing too much on the relationship between other crap currencies. Yeah, sure. The dollar, as many will say, is the the cleanest shirt in the dirty laundry hamper. Measure it against gold, and it's being destroyed. And measure prices in gold ounces, and prices are falling. We are in the midst of a deflationary cycle. We just don't realize it because the currency by which we measure it against is being eviscerated in terms of its purchasing power. My father graduated college in 1963, married my mom. They're still married today. And he said to me, when I graduated college, my first job out of college was at a place called Helene Curtis. It was like a women's cosmetic thing. He was paid $6,000 a year. He said we lived comfortably on that in an apartment, just the two of us. I'm thinking, how is that possible? If you Google what was the average salary in 1963. It's like 9 or 10 thousand bucks. So first job out of college, okay, I believe that. And he could live comfortably on $500 a month. So you ask yourself, is it the prices that we're looking at, or is it what we are valuing it in, measuring it in, that is the real issue? And to me, that is the real issue.
Just a very quick break, guys. So I've spent the last 12 months creating this course, Wealth Building Blueprint. I've put an unbelievable amount of effort into it. I cover investing, trading, speculating, business. The course is perfect for people who are still relatively new to this wealth building process. And I also offer 3 days money back guarantee. No questions asked. If there's absolutely anything that you're not happy with, you will get your money back. There's also a private community where you can ask me any questions, you can talk between each other, you can share news and things like that. The link will be in the description. Right now the course is at a 70% discount, and let's continue with the video. Good points, Andy, again. I think most people are aware of the fundamentals that moved gold with the central banks getting involved and everything. But at the current price, Andy, would you agree with the statement that the retail investors, especially in the West, are still not that much involved with gold? Now, I was talking about Keith Neumeyer recently. So he was saying that, for example, they did have a record month in September for their first Majestic mint. But overall, what is your assessment of the sentiment in the West?
I think that, again, and I like Keith very much. He's a smart guy, and in the industry, he's one of my friends. And I think there are very few people who are as qualified to answer these kind of questions as Keith, not only as the CEO of First Majestic and board member of many other projects, serially successful at that, but he also now, as you mentioned, runs the First Majestic Mint. Yes, a business over the last few months has been parabolically higher than it had been any time since the pandemic. As Rick Rule would say, always, again, using Rick's comments, which I've copied, I've been friends with him for 25 years, is that from the average allotment or allocation of gold and gold-related equities from Joe and Jane Sixpack to the Harvard Endowment Fund is less than 1/2 of 1%. Now, the interesting thing is that the Harvard Endowment Fund just spent, I don't know, between 1 and 200 million on gold recently. Things are changing, but it's at that level that we're seeing the majority of purchases. During the silver squeeze, everyone and their sister and brother was calling us, and we were doing, 1,500 orders a day. Now it's a fraction of that, maybe 500, but much bigger in scope. You have people who are scared that the realization that things not only are messed up politically, geopolitically, morally, socially, even take your pick, go down the line, but that the dollar's in trouble. We can't even agree to keep the government open through things that, I'm not going to talk politics here. I have strong views on it, but it usually ends up being too polarizing. So we'll just simply say we're at a place where people who have worked all their lives to obtain money realize that it's easier to make it than it is to keep it. And so we've seen a big rush into metals lately, but that's still, look at what I said at the beginning, record allocation to the equity market by the public, record speculation through options and leverage through margin, all-time highs across the board. And at the same time, this month alone, we've already seen almost 59,000 gold contracts. Yeah, 59,000. So it's 58,639 as yesterday times 100, 500, 5,863,900 ounces of gold have already been delivered on COMEX this month. Every single month, we're seeing this kind of volume. That's never happened before. No one ever stood for delivery, ever. Less than 1% of contracts always stood for delivery on COMEX my whole career. And I've been screaming as loud as I could since 2020, since I got on YouTube, saying things were changing, that we have been seeing the constant offtake of metal through family offices and hedge funds under the title that came out of nowhere in 2020 called the others. This is the commitment of traders report that is published by the commodity exchange, it was usually just two-sided, the commercials, which commercial banks, and the specs, the hedge funds. And they were zero-sum game. It would show the positioning of it shows the positioning of the biggest traders. Then out of nowhere, this third group of reportables pops up. They call it the others. I expect this as hedge funds and family offices. They start taking huge deliveries off the exchange. Central banks have been doing it since 2017, but they have friends and wear different hats. And these are hedge funds and private family offices and sovereign wealth funds. And then you're seeing the same thing with the central banks. But you're seeing, never saw it here in the US. We've been net exporters of gold forever until November when Trump won the election. We've become, if not the largest importer of gold in the world, all of a sudden. Who's doing it? Why is no one talking about it? Why are we seeing billions and billions and billions and billions and billions of gold and silver come into the COMEX? Some stays, some leaves in the COMEX. Could stay in there, can leave. I don't know who's taking it. Why aren't we hearing about it? Why is there no mention of this on the media? I talk about it every day, but at that level, it's the people far above you and I and everyone else in this room who are the ones that have been buying it. The institutional traders, the sovereign wealth funds, the central banks. But to see it happening at this level, where you get the chief investment officer of Morgan Stanley now saying, instead of it being a 60-40 split between stocks and bonds, as Wall Street has used for 50 years, that was the typical portfolio. And in an interest rate environment that's going straight down since 1982, that would have done well. 60 stock, 40 bond. Now he says, no, 60, 20, 20. Sell half your bonds, put half in gold. Michael Hartnett, the chief analyst for Bank of America, no, he says 25 stock, 25 bond, 25 short-term treasury, 25 gold. You got Jeffries, a former U.S. Mint authorized partner who I worked with for years, and they nominated us to be a authorized reseller. They were one of the primary distributors for all the mints. They know gold better than anyone, although they're not in that market anymore. Next stop for gold, they say 6,600. You got Jamie Dimon talking about it. You have Goldman Sachs talking. Everyone's talking about it at the ultra high level. Those people have been doing it, but the public, no, they're still anesthetized. But like I said, if it's a 0.5% and it goes to 2%, well, that's a fourfold increase in demand. And guys like Keith would notice it. And it is getting busier. I notice it, but we're yet anywhere near, I think, that level where the public has woken up to the fact that the road to retirement is not always just paved with stocks and bonds and mutual funds. Quite to the contrary, we are entering a period of time where even the best laid plans need to be reevaluated.
That's a good point, Andy, because I do hear people around me talk about the crypto sector, but I still never hear anyone talk about gold, which again proves the point.
Oh, where do you live?
I live in Ireland.
See, it might be a little bit different. I'm not as familiar with what's going on there, but here in the United States, I mean, I've owned a gold company for 36 years. People know what I do. Um, but I couldn't have a coherent conversation with 98% of the people I know outside of work for more than 3 minutes on the merits of gold or macroeconomics. Um, and that's the problem, or that's the point. And that plays right into the hands of the big money who has used misdirection of price, of rhetoric, and of lack of media coverage to reposition well ahead of the masses. And that's why I've been screaming for 5 years now, going on 6, that the big money is accumulating physical metal, standing for delivery. You look at almost 40 nations have brought their gold back from the Bank of England and the New York Fed. These were the entries into the COMEX and the LBMA. Why repatriate it? Why bring it home? Why go on a massive buying spree? Why reclassify gold, in essence, as a high-quality liquid asset or a tier one asset, the way they treat it as a tier one asset? Why are we seeing all of these things and yet the public doesn't understand it? Is because, well, people who watch guys like you and I have seen it, but the rest of the world, they don't see it because they're following a mainstream media that has completely blackballed it and ignored it. Maybe that's by But maybe that's on purpose. Every radio, TV, newspaper, every media outlet in the United States is owned by four companies, so the information is filtered to their liking. And there's a fine line between conspiracy and reality. I'm not trying to sound like a nut job, but it's true. I mean, you're going to ask yourself, why is it that gold has outperformed everything? How about this one? Gold has quadrupled the performance this year of the S&P 500 in the midst of the greatest AI tech boom in history, right up there with the advent of the internet in terms of significance. And it's quadrupled it this year. But where is the coverage of it? Nowhere. So it's an interesting phenomenon.
Yeah, so we have gold at all-time highs, Andy. But if we look at its younger brother or sister, silver, it's still below the all-time high that we've seen in 1980s. If we inflation adjust that, that's going to be over $200 per ounce.
Well, to
Also,
be fair, it was above it reached its all-time high 2 weeks ago or so at $54. But I get your point. I understand it. And you could argue, I could argue, and again, fine line between conspiracy and reality. You have 8 Western banks that have maintained out of 1,000 plus commodities traded on the COMEX, the largest concentrated short position in any commodity ever traded on COMEX, and that is in silver. Why? That's a question that should be asked more than anything. Of course, you don't have any journalistic integrity anymore in the media, so they don't ask why. Why would JP Morgan be allowed to be the custodian of the world's largest silver trust, SLV and GLD, but SLV, after paying the largest fine the Justice Department ever handed out of $920 million for spoofing or manipulating the silver market? Now, many people thought they should have been brought up on RICO charges. People should watch Chris Marcus' Arcadia Economics channel and Google the podcast he did with Bart Chilton, who was the former CFTC commissioner, where he talks about this, admits a lot of this stuff I'm saying, and he dies a week or 10 days later. Now, could have been, they say it was natural causes. Maybe, probably was. I'm not saying there's a link between it, but he spoke out to what JP Morgan has done in the market. And very clearly, Chris Marcus, Bart Chilton, Arcadia Economics, watch it. Everyone who owns gold should watch it. And silver. But the thing is this, the why to me is fairly easy if you have an open mind, and that is that the military industrial complex needs massive, massive, massive amounts of silver to manufacture high-tech weaponry. Go to silverwars.org and you'll see how much they need. They used to publish it within the supply demand figures from the Silver Institute. They now omit it. We've had over a 200 million ounce shortfall between supply and demand for 5 years running. The military industrial complex is running the country, running the world in the respect that they're the ones who are making these decisions. In essence, this is what we were warned about a long time ago, but they make high-tech weapons and sell them around the world. Who owns the majority of the weapons manufacturers? Well, that's BlackRock. Who's the other primary custodian of SLV with JP Morgan? Oh yeah, that's BlackRock. There's a 81 or 2 million share short position right now in SLV, which drives the paper price down, and then they go in and take it and do what with the money? Do they buy physical? What do they do with it? I don't know. We'll have to figure that out later. We don't have enough time to talk about it. But my point is this. You look at BlackRock, who is, in many respects, in terms of their ownership of all of the weapons manufacturers, highly tied into, if not part of the military industrial complex, who makes high-tech weapons that need massive amounts of silver, from cruise missiles to ICBMs to F-35s to stealth bombers, you name it. They all have tons of silver in it. And this is not just in the United States. These are the kind of UK, France. Have all been in cahoots with this. Standard Chartered Bank, HSBC. These are all the banks that were told, by my belief, by their respective Western governments, step on the price of silver, don't let it go. We need silver inexpensive enough so we don't get crowded out of the trade. And it's not even about the price going high, it's about its diminishing in nature. It's disappearing. Ask Keith Neumeyer, he'll tell you it's coming out of the ground at 7 to 1. He's told me that personally for years. 7 to 1, but it's priced at 88 to 1. It was priced at 16 to 1 for 5,000 years. So a company like BlackRock, who is the primary custodian, along with JP Morgan, of the world's largest silver trust. And there's an 81 million share short position, which, in my opinion, should be legal. In essence, you're creating shares out of thin air that aren't backed by silver. Even they came out and wrote in the prospectus that be careful shorting this. There could come a time where you can't get the shares or the metal back, and you could be exposed to a huge squeeze. But the point of it is that they're the custodian of SLV with JP Morgan, and they are, in many respects, the military industrial complex. So when we sell weapons all around the world to places like the Ukraine, and Ukraine gets blown up, who gets the reconstruction contracts? Yes, that's right. It's BlackRock. And so when you talk about why has silver not performed, it's because there are 8 Western banks that have held the largest concentrated short position in the history of the COMEX market. But as I've said for 2 years now, slowly, methodically, the BRICS nations are exposing this. And they have been standing for delivery. That's why the LBMA has its lowest amount of silver in ever since they started keeping records, about 150 million ounce float against 2 billion ounces in paper contracts that could stand for delivery. They're trading 600 million ounces a day in paper contracts. What could go wrong? And that's why you're seeing this panic. This is why they slammed the price of silver down, in my mind, the other day, and a whole bunch of silver that somehow flew to London to keep the thing going, that maybe gave them another month or two, ease the stress. That's why London was T plus 8 weeks most of the year for delivery in a market that is T plus 1 day. In other words, T trade day plus 1 settlement. The third day, the bar should be moving. Sorry, they said, for a good portion of the year, the Bank of England, we have a shortage of manpower and trucks in London. We're not able to move your metal fast enough. That means they got caught with their pants down. It's close. And it's because the countries around the world who are now coordinated, motivated, sophisticated, and wealthy say, aha, you want to play this game? We'll beat you at it. We'll suppress the paper price too, and we will stand for delivery as well, because now we're wealthy. And now we see what you're doing. In fact, we're smarter than you. We will use your suppression of the paper markets against you. And that's what's happening. And someone in the West, I think, thank God, got to Trump and said, if we don't do the same thing, we're dead. And now you have the US government proposing, and already in draft form, reclassifying silver as a critical mineral. It will have its day. Um, and the deliveries by the most not only well-funded, well-informed traders in the world have been bleeding dry all the silver they can that's not nailed down. You have China, the second largest producer in the world, flying all across the globe, largely in Latin America, Peru, Mexico. They're buying doré right from the miners, like Keith, and concentrate, which is a byproduct of sludge. Doré are the crudely refined bars, and sending them back. They pay double what the West will, and send them back to China to refine it in themselves. This is the second largest producer of silver in the world. Why would they do this? They see the big picture, and they've been using the stupidity and our hubris of suppression, keeping the military industrial complex able to get silver without the world rushing to get it, knowing its true value, looking at it as, why the hell wouldn't it go up in the face of all of this craziness and inflation and blah, blah, blah. They know that. So they step on it, make everyone say, see, it's a piece of crap. Don't buy it. Right. That's right. Until the suppression ends. And one of these banks that have been shorting breaks ranks to cover, and the whole thing blows apart, or worse yet, a failure to deliver. You see a failure to deliver in London on one of these major banks. These banks aren't just bullion banks. They have their fingers in every financial pie across the globe, and the contagion, the systemic reaction would be very dangerous. So yeah, silver will have its day. The only way you can manipulate a market for a very long period of time is to push it in the direction that it is going. And they've been able to do that quite handsomely for a long time, until all of a sudden we're the most well-funded and well-informed traders across the globe, including here in the United States, understand the significance of standing for delivery instead of rolling forward paper promises. And I think we're at that point right now.
The fascinating stuff, Andy. And if we look at the mining stock, so I'm very much involved with that sector. And if you analyze some of the producers at the current commodity price, never mind higher, they're feeling much comfortable. And on many metrics, they're still quite undervalued. How are you viewing that sector?
I think it's It's the same thing I'm talking about on steroids. The only thing I would caution is that, you could look at the mining shares as the sponges floating on the surface of the bathtub. You pull the plug, they'll all fall, including the mining shares. But I do think, from a standpoint of undervaluation, as gold and silver have risen to these levels, the mining shares until just recently hadn't cooperated. And so, yeah, you have mining companies right now that have um, a lower cost of production than the price is at. They're flush with cash, and I think it's a tremendous place to put your money. But I think that I look at it as a pyramid, where the base of your pyramid would be things like paid for real estate and physical metals and assets. The middle portion would be something like 60-day treasuries or utility stocks throwing off a yield, a dividend with a little more risk, but still relatively conservative. And then the pyramid, the top of the pyramid, 10, 15% would be mining shares and cryptos. And the theory is you lose every penny that you put into it on the top 15. You don't make nothing on the middle 20 or 30. As long as the base of your pyramid is moving at a couple, 2, 3, 4%, you're in good shape. Well, gold has averaged 9.9% per year since 2000. So you're doing well. In other words, to me, you don't invert your pyramid to speculation. But if things go well, you'll make more money on the top 10% than you would on the bottom 90. So it's a Swiss-based formula they've used for 300 years. It's just mitigating risk and making sure that you never invert your pyramid to speculation. In other words, you don't gamble with your retirement and your future. There is a piece of your portfolio that you can, but to gamble with the majority of it is lunacy, and that's kind of what I'm getting at. But the potential and the leverage is unbelievable. There's, again, this is just a generalization, but there's probably more market cap in Coca-Cola than there is in every mining share on the planet combined. So, you know, there's plenty of room to see growth in the mining share industry.
Yes, Fundy, I like to ask this question for the younger audience. If we have an individual who's still at the beginning of his or her well-building path, with all the chaos that we're seeing, with all the options that we have with different sectors, what advice would you have for them so that they can start off their well-building path the right way, their investing career, and not make too many mistakes?
The same advice my father gave me 35 years ago: pay yourself first, and every 2 weeks you get paid. I bought gold and silver. That was the only thing he asked of me when we started this company in 1990. Buy something every 2 weeks, an ounce of silver, whatever you want, something, some metal. So I don't look at gold and silver as an investment. To me, it's my wealth. I've bought it every 2 weeks for almost 36 years. February will be 36 years. Never missed a 2 week period. Let the laws of compounding work for you instead of against you. Most people go in deeply into debt and think that's the American rite of passage. It's not the case. And I think if you let the laws of compounding of time and effort work in your favor, and interest, but in this case, for me, the non-interest bearing assets still outperform those that were interest bearing. You pay yourself first and you prioritize your future self, because procrastination is built into our DNA, I guess. And I'll do it tomorrow, but tomorrow comes faster than you think. I'm 55 years old, and it seems like yesterday I started this company with my dad in a one-room office the size of a closet before the internet. And just like that, I got three kids. My youngest is a freshman in college. And I remember the day they were born. Well, how did that happen so fast? Because life is like a roll of toilet paper. And when you're young, you don't notice it spinning. But as you get older, it starts to spin faster, and you start to actually notice the end of the roll is there. You never think about it when you're young. And so prioritizing yourself first and saving every 2 weeks, no matter what, or every time you get paid, even if it's just a very nominal amount, it adds up over time. And you see people who are in great shape, they don't go to the gym, you know, once a month, or really hard the first month of the year. When I used to work out all the time, when I had more time, I remember there would be the month of January, the gym would be filled with people. by February, it was half that amount. The people, the resolutionists, decide to leave. Those that were methodical and habitual in paying their future self first in terms of their conditioning and their physique or whatever you want to call it. Well, they're the ones that were always there, and being habitual and getting into a routine. So for the young folks, I would say pay yourself first. Let the laws of compounding be your friend instead of everyone else. It is their foe, and uh, and let the laws of time and effort and energy and interest work in your favor. And I think that's the best advice I've ever received myself. And if people think about it for a moment and find a way to save in something like gold and silver that over time, because of the devaluation of the dollar, will do well. If you save in assets, that is the key. Saving dollars, you'll go broke. And that's the most important thing, at least right now, in my mind, to recognize.
Great advice, Andy. So these are all the questions I had. Is there anything else that maybe you would like to mention that we haven't covered?
No, I think you did good, but let's save it for next time. Love to come back on. It's nice to see that you're growing your channel, and I'm proud to be part of it. And I appreciate you having me on. As challenging it was for us to finally connect, I'm glad we did. And I hope that you and your listeners have a great rest of your week and weekend. And I'll look forward to picking up with you where we left off sometime shortly down the road.